Hi, my name's Gill Witham, a Senior Advisor at 5Financial. This is the second of two videos with BlackRock, the model manager of the iShares Strategic Enhanced Models that you have all invested in. We are joined again by James Waterworth, National iShares Specialist at BlackRock, to discuss these models and more. Jimmy, hello.
Hi Jill, thank you for having me back. We continue to wish you all well in these difficult times. The markets continue to be dynamic as the health situation continues to evolve.
We had fantastic feedback from the first video and encourage those who have not watched it to do so. It helps provide a base for today's edition. That said, we want to explore a few areas in greater depth. Jimmy, are you ready to roll?
Sure, Jill, let's do it.
Excellent. So we wanted to start with focusing on some of the key reasons we selected the BlackRock models. The first is a focus on risk management, which in times like these is of heightened interest. Can you please explain the process?
Sure. In the first edition, we explained that BlackRock employs a total performance management investment philosophy in creating and managing our model portfolios. This involves seeking to optimize forecasts of returns, risks, and incorporating a transaction cost penalty with the aim of ensuring unnecessary portfolio turnover. That is, costs is kept to a minimum. From a risk perspective, the adage of not putting all your eggs in one basket was also mentioned. In financial parlance, this is referred to as diversification. So firstly, it's worth noting these models are multi-asset class. That is, they invest in cash, fixed income, and equities, instead of just one of these asset classes. Within fixed income and equities, we will also invest both domestically and internationally across developed markets like the USA, Europe, and Japan, as well as emerging markets such as China, Taiwan, and Korea. So this answers the question from a portfolio construction perspective. That is, we seek to manage risk by not putting all of our eggs in any one asset class and instead diversifying across and within asset classes.
This is something we spend a lot of time talking to our clients about, seeking returns from diversified sources. It's also important to note the portfolios are not set and forget. Is this correct?
Correct. Viewers of the previous session will recall that BlackRock does not use a set and forget approach to building models. We always seek to enhance our forecasting methods, feeding the potential enhancements through to new and existing models equally, as part of our fiduciary duty to act in the best interests of our clients. The models your clients are invested in rebalance on a quarterly basis and can rebalance out of cycle when merited to. These are relatively low turnover strategies with one-way turnover in the range of 40 to 60% per annum. We're mindful of costs associated with turnover, and as part of our total portfolio management, we look at both the transaction costs as well as the expense to investor of holding each ETF within the portfolio and factor these costs in when adjusting portfolio weights.
Thanks, Jimmy. You also mentioned Aladdin, your proprietary risk management software, on the prior video. Can you please remind us how this is utilised?
Sure. Aladdin is our end-to-end software operating system for investment professionals, such as the team that manages the model portfolios, to see their whole portfolio, understand risk and exposures, and help us make more informed investment decisions and operate more efficiently. Through the Aladdin platform, BlackRock helps clients navigate volatility and market uncertainty. Those who tuned in previously will recall I stated that it's all well and good having a sophisticated system. However, we also aim to have rigorous risk management procedures and controls for this strategy. Regardless of investment strategy, all our client portfolios have regard to a single risk management philosophy. We believe that risks for portfolios should be deliberate, diversified, and scaled. Of course, we do have to note that risk management and diversification aim to support the objective of, but do not guarantee positive returns.
Thanks, Jimmy. Another thing we educate our clients about is being mindful of costs. Can you please expand on how this applies to the model portfolios?
The building blocks of our model portfolios are exchange-traded funds, ETFs. A key advantage of this approach is that ETFs enable investors, even those with limited capital, to assemble broadly diversified portfolios at a low cost. Let me illustrate this. Say one of your clients invests $100,000 in our balanced model. That is 50-50 bonds and equities. Through your investment platform, NetWealth, they will purchase approximately 15 ETFs per the model weights. The management fees of the underlying ETFs will range from 0.04% to 0.074%. However, when you blend these to determine the weighted average management fee, it is 0.22%, using the rebalance weights at our last rebalance on the 27th of March. This means an investor would pay about $2.20 per year for each $1,000 invested in this model portfolio. Given that in this case, the client invested $100,000, that equates to circa $220 per year. This example underscores the low cost, ease of trading and transparency advantages of model portfolios. Investors can see at any time exactly what they hold, or what you see is what you get portfolio. It is to be noted there are other costs that you and the 5Financial team can walk the clients through.
Indeed, we walk our clients through all the costs during our client engagement and review process. You've mentioned your total performance management approach a couple of times, referencing you consider returns, risk and costs when building the portfolios. You've talked to the latter two in this video. Would you also be able to elaborate on how you think about returns?
The first step in the portfolio construction process is defining the strategic asset allocation, SAA, which is the foundation portfolio that seeks to build wealth and is not designed to make short-term bets on market moves. The SAA is developed for a long-term investment horizon that seeks to benefit from diversification across asset classes. It is reviewed by the investment committee on an annual basis in order to continually evolve the portfolio benchmark construction and to incorporate updates to the long-run risk premium, risk, and correlation assumptions. Now, it's impossible to distinctly separate out returns from risk, as we're all familiar with the risk-return trade-off. Based on the return and risk assumptions, the SAA is allocated to growth and defensive asset classes for each risk profile in the model range. Growth assets are defined as Australian and non-Australian equities, and defensive assets are defined as Australian fixed income, non-Australian fixed income, and cash. The SAA is developed with a 10-year time horizon using BlackRock's capital market expectations. We use an optimization framework to determine SAA candidate portfolios. These portfolios are tested with historical asset class data, historic and simulated stress scenarios, factor shocks, and analyzed with respect to overall exposures and look-through exposures to risk factors, stress events, drivers of significant drawdowns, etc. In addition, we use statistical models and non-normal asset return distributions to test our expectations for portfolio returns, volatility, and expected shortfall.
That is quite the process.
And it doesn't end there. The asset class allocations are then mapped directly onto the chosen implementation vehicles, ETFs, in the investment universe to formulate the SAA. We use a quantitative process to dynamically tilt towards or away from assets 4 to 6 times per year, based on in-depth peer-reviewed signals that support the potential to deliver returns in excess of long-run SAA. These include valuation signals, cheap versus expensive security, changes and speed of changes in credit spreads of fixed income assets, amongst others. This is based on our belief that being long-term and avoiding short-term noise does not mean ignoring what is happening in the changing market environment. We aim to improve upon the SAA performance by being market aware. The tilts are determined systematically, utilizing a continuously reviewed process with a view to, in aggregate, seeking to deliver higher risk-adjusted returns. The beauty of the model portfolio is all changes and upgrades to the investment process automatically are incorporated into the portfolio.
And so that is where your assumptions come into play again around trading costs.
Correct. We're mindful of transaction costs as explained earlier. Returns, risks, and costs are all interwoven into the portfolio construction process that we implement.
How does this all translate into performance?
The models were incepted in January 2015, so are over 5 years old. We regularly publish our performance reports. However, it is to be noted every investor will experience their own journey, depending on when they entered, how cash in the model itself is managed. That is, seeing as each investor owns each ETF within the model, one investor may choose to participate in dividend reinvestment, where others may not, into the models and which model they invest in. We know this is something you supply your clients via their investment platform, NetWealth.
Yes, we do. If anyone watching wants to receive their latest performance report, please get in touch with me or your respective advisor.
Excellent. We also appreciate we are not the only investment manager out there, so we compare ourselves versus our peer group. Over 3 and 5 years, as of March 2020, we are first quartile. That is the top 25% of our peer group across all of our portfolios versus our peers from a returns perspective.
That's excellent, and one of the reasons we choose BlackRock as the model manager. Changing tack, how does BlackRock think about ethical and sustainable investing?
Great question, and particularly topical in Australia after the fires over the summer. First off, it is to be noted the model portfolios are not explicitly managed to an ethical or sustainable objective. Though this is something we may explore in time. This is not to say we are not addressing some of these issues, far from it in fact. BlackRock, as a fiduciary investor, is obliged to work on behalf of its clients, the asset owners, such as the clients listening today, irrespective of whether they are invested in a sustainable or mainstream investment. Our global investment stewardship team, with local Australian representatives, is tasked to fulfill this role, and as the world's largest asset manager, this is a significant responsibility. The investment stewardship team directly engage with companies. They emphasise direct dialogue with companies on governance issues that have a material impact on sustainable long-term financial performance. Further, the stewardship team performs independent research and analysis, carefully arriving at proxy voting decisions, including the re-election of directors that are consistent with our voting guidelines and we believe are in the best long-term economic interests of our client. Lastly, they promote thought leadership, engaging on public policy issues and participating in market-level dialogue to contribute to the development of policies and practices that support stewardship, long-term investing, and sustainable shareholder returns. So they're busy.
Yes, I can certainly see that. And can you also comment on your management's client letter earlier this year?
Absolutely. The letter written by our CEO, Larry Fink, sets out sustainability as BlackRock's new standard for investing. Over and above what I've already referenced, the shift by clients to considering the impact of sustainability on portfolios has been driven by an increased understanding of how sustainability-related factors can affect economic growth, asset values, and financial markets as a whole. Because sustainable investing options have the potential to offer clients better outcomes, we are making sustainability integral to the way BlackRock manages risk, constructs portfolios, designs products, and engages with companies. The letter further states that we want to make sustainable investing more accessible to all investors and lower the hurdles for those who want to act. Environmental, social, and governance criteria, also known as ESG, are a set of factors that socially conscious investors use to help screen potential investments. We've been working to improve access for several years, for example, by building the industry's largest suite of ESG ETFs globally, which has allowed many more individuals to more easily invest sustainably. And we're committed to doing even more, including doubling our global offering of ESG ETFs over the next few years, including sustainable versions of flagship index products, so that clients have more choice for how to invest their money.
Very interesting. Thanks again for your thoughts and time today, Jimmy. Insightful and engaging. On behalf of 5Financial, I'm very grateful.
It's my pleasure. I'd also like to thank you and your clients for your support. We wish you all the best in the coming weeks and months.
Thanks, Jimmy. Have a great day all.